This was Alan Ruskin at Deutsche Bank. This quote here: the 23 median dot will superficially be bearish relative to the December 23 Fed Fund futures, but not relative to market expectation for the dots themselves. If you don't understand that quote, here's this quote: the market will probably also take the Fed's higher end 23 dot as a way of the Fed trying to signal that they do not expect to cut rates in 23. That's something the market will continue to view with skepticism. Bob, I would love your thoughts on this. This battle between a market that's pricing in cuts and a Fed that's saying, no, 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 we're not doing that. How does this play out?
Well, I think it plays out with the Fed pausing sometime over the next couple meetings and leaving rates wherever that may be, somewhere between 4.5% and 5% through year end, just to ensure that they've gained some traction on inflation. And Krishna is right. The labor market is still very tight. Wages are going up. At some point in time, the price increases, the sticker shock from that, may just be normal, and wage gains will compensate for that. The other thing on the horizon is a reopening of China, and that should add to a lot of consumption. So it is too early for the Fed to declare victory on inflation.
So Bob, let's talk about rates. 2-year right now, 4.20. 2-year November 4th was pushing 4.80. That was 2 days after the Fed last met. Is 4.80 it, Bob? Can we get back up to those levels at the front end?
I would love to get back up there, but I don't think so. I think we've seen the peak in inflation. We've seen the peak in rates. I think the market told us at 4.80, the highest the Fed is going to get the Fed funds rate is 4.75. The market's going to be right yet again. Any kind of backup in yields you're supposed to buy.